Could carrying a little debt actually boost your financial health instead of dragging it down? Let's find out. Welcome to the channel. Every day I explore personal finance questions that real people are asking on Stack Exchange and highlight the top answers from the community as well as any key takeaways. If you're new here, consider subscribing for daily videos just like this one. All right, let's take a look at today's question and break it down. Today, we're exploring a common question. How smart is it to really be 100% debt-free? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. So in summary, over the past 2 years, this person has been working hard to become debt-free, all while keeping their cash flow steady. Even with a decent salary, they're still juggling education loans, a car loan, and a bit of personal debt. Now they're wondering if it's smarter to aim for total debt freedom or if holding on to some debt might actually be a good thing. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. In this answer, the person highlights that debt raises financial risk, especially if someone loses a job or faces surprise expenses. They suggest comparing investment gains with loan interest rates to decide between investing or paying off debt. Paying off loan principal early can significantly cut total interest costs. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. Here's another answer that was shared in the Stack Exchange thread. Like before, I'm going to scroll through it quickly, so feel free to pause the video if you want to read it yourself. Otherwise, I'll highlight the main points of this answer in just a few seconds. One response points out that people should only borrow for assets if their income exceeds the debt cost. It also suggests eliminating current debts that don't generate income and prioritizing paying off non-productive debts. Here's one last answer from original post on Stack Exchange. I'll quickly scroll through the answer so you can read it. Feel free to pause the video if you need more time. And just like before, I'll be highlighting the main points of this answer for you in just a few seconds. One response points out that interest rates on debt can range from 2.5% to 24%, and prioritizing retirement savings, especially with an employer match, might be wiser than aggressively paying off debt. Having savings offers financial stability during unemployment, even with a mortgage. All right, now that we've seen what the community had to say, here's our take on this question. Tackling high-interest debt is a smart move because it cuts down on interest costs. Start with personal loans, as they usually have higher rates than student or car loans. Meanwhile, keeping low-interest debt can be wise if it lets you invest in higher return opportunities, like a retirement account. And don't forget to maintain some emergency savings to handle unexpected surprises without stress. So in this video, we've covered how debt can be a useful tool if it brings in more returns than it costs. It's smart to tackle high-interest debts first, while weighing investments that might outpace low-interest loans. Balancing debt repayment with saving for emergencies or retirement is key, and having cash savings provides security during uncertain times. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.